Welcome to the Dividend Talk Podcast, episode 188. 5 dividend growth stocks from the consumer staples sector. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. How are you, my friend?
I'm doing really well. It's actually we are recording this time on the Monday evening because both of us are not available next week. So we just came, of course, after the podcast from 2 days ago. But I actually feel quite energized, and maybe we should do more often on Monday because sometimes on Friday I'm tired, but now I'm still full of energy at the beginning of the week. But also a lot of good stuff to look forward to. But tell me, how are you doing?
I'm good. I'm good. It's a busy day, so it is now close to 7 a.m. I travel at 3 a.m. this morning, so I have a couple of hours sleep. So I try to get this done. I get some sleep, and I'll be ready to go. But I'm looking forward to this. We had this planned probably a couple of weeks. So consumer staples. It's a interesting choice, I would say, and we'll get into some of the reasons why. But before that. Look, it's only been a couple of days since our last podcast, but has there been anything else in the news over the weekend that has caught your attention?
Well, definitely one thing that we didn't discuss really yet, and that is Salesforce new dividend. So they started initiating a quarterly dividend of 40 cents per share on the back of the strong fourth quarter earnings, which is very interesting, right? We had Meta the other day. Was it bookings as well?
Yes.
Now Salesforce. So the big ones are coming. So it raises the question again: when will Google announce one? But for me, that Salesforce started to pay a dividend, I think, was about time. It's a large company, and at a certain moment you get into this era where you've got money left in the end of the month, right? So I think it's wise that they start paying a dividend and also look after their own employees with a lot of shares, right? So they get some additional income without needing to sell the shares. So I think it's good to start focusing on this at this moment in time.
Yeah, it's starting to show the maturity in this sector, isn't it? We got a question last week about our favorite technology dividend stock, and there wasn't a whole lot to choose from, but actually there's a few starting to come online now and starting to pay us a dividend. Look, I think Amazon and Google, it's only a matter of time, but once Meta paved the way, I think it opened up a few people's eyes and they've jumped on board.
Yes, exactly. So I don't own Salesforce with ticker symbol CRM. It's still, of course, very, very little yield, less than 1%, I believe. So not so interesting to me. But I'll keep an eye on it. Who knows? Such a company at a certain moment can get some headwinds in the sense of share price pressure. Who knows? Maybe it will end up in our portfolios one day.
Yeah, let's see. Who knows? Nobody can read into the future. But staying on dividends, Saudi Arabia's state-owned oil giant Aramco boosted its dividends yet again, and this is despite profits falling nearly 25%. If I'm not mistaken, they are the world's largest company, or thereabouts.
Yes, but also the largest dividend payer. I will tell you, 100 billion, 97.8 billion in a single year, 30% more than last year. Hallelujah. I mean, this is a lot a lot of money.
I mean, if you look, their dividends is 100 billion, and their profit fell 121 billion. Just to put that
Yeah.
into perspective, that's big, big numbers.
Yeah, but if you want to buy players like Ronaldo, buy a football club here and there, it costs a lot of money, right, to fund all of this. And I read an article about this, that this dividend hike was pretty much needed. They are also, I think, building this wall in Saudi Arabia, this city in a wall in the middle of the desert.
Yeah.
So yeah, they need a lot. They need a lot of money to fund all their initiatives, and but at least I don't like the human rights situation there, but this is not a political podcast, so let's refrain from that. But what they're trying to do well is I think they see the clock ticking around oil and gas, and they are investing in the future with a lot of these kinds of things. Not sure if they invest in the right things, but it's so funny to see this, right? Who would have known that if you wanted to have steep dividend hikes and lots of dividends, like 30%, that your best friend would be the government?
Well, yeah, it depends on the government. Maybe not Western governments, but you can see. But look, oil revenues is 62% of the total state. I mean, that whole state, 62% is made from oil. So,
Yeah.
look, it's no secret why they can buy clubs like Man City. Oil is paving the way. But I honestly think they're doing the right thing investing now. I think you're right. They see oil is not infinite, and they're trying to make use of that money in any way that they can. I've seen that city or pictures of that city, that giant wall. Looks scary. It looks impressive, first of all, but scary as well. It's just a long, 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 long stretch of
Yeah.
houses and apartments, and there's a big football stadium in the middle of it, and
Wow.
crazy stuff. Crazy stuff.
Yeah, so 100 billion, maybe Apple or Microsoft will come there one day. Let's see. It's definitely a lot of money. But maybe let's go straight into it, because I really would like to talk about 5 stocks from the consumer staples sector, defensive sector.
Yeah.
And one of the things when we got together, like not too long ago over here in Poland, we said like we're brainstorming a bit about the ideas of what things we can do. We typically have the earnings, we have the quarterly reports of ourselves. We have some knowledge related topics, but we also said like, you know what, we need to go back to these country topics or sector stock topics. So for now we have chosen to do each month a different sector, and we wanted to start with the consumer defensive sector, because effectively this is the sector where most of us buy their first shares in. Yeah, so I felt like we should start with this one effectively. So maybe a few words about the consumer defensive sector before we start. And I use consumer defensive, but you could also say staple, right? It gets used interchangeably. But effectively, these are companies in this sector that really produce essential goods and services that people tend to buy regardless of any economic conditions. So if you're familiar with the Maslow theory and the Maslow pyramid, for me, it's kind of at the bottom, right? It's like food, shelter, and the rest. Yeah. So they're really essential for daily living. And, they also, we need them to be stable. If we suddenly see this blowing up, who knows? Maybe we end up in the civil war or something like that. And some key characteristics of these companies in this sector are really stability of demand. They often offer food, household items, personal care, these kinds of things. Often they have also reliable cash flow. They pay typically reliable dividends, and they are less cyclical. What also means that many of them have above average debt levels, because if your cash flows are stable and you can pay them off, then also banks are usually more willing to let you have more debt on the balance sheet. So this is also what we will see with some of these stocks, that they have beyond normal levels of debt when we're talking about it.
Yeah.
So this is a little bit about the consumer staples sector, and we have some really big companies. I think Walmart is the biggest one in the world. They have a market cap of almost $500 million. Second is Procter and Gamble, then Costco, Coca-Cola, Pepsi, Philip Morris, Unilever, Anheuser-Busch, AB InBev, let's say, Mondelez, Diageo, Target. I mean, you name it, right? Let's not even forget about the tobacco stocks here and Estee Lauder and such.
Yeah, yeah. It's a long list, and actually you were talking about the characteristics, and I opened up the MSCI European Consumer Staples ETF, or not ETF, the unit trust, and their top 10 is most of what you nearly called out, except for I had Nestle as number one, Unilever, L'Oreal was there. You're forgetting about L'Oreal. Ahold is obviously there. Your Budweiser that you tried to pronounce is there, but the characteristics is what they call out in all of these stocks, and they say, right, number one, value. All these companies, consumer staples, are relatively inexpensive stocks. I don't know if that's true. This is what they're saying. Low size, so they're saying they're smaller companies. And you mentioned the size of Aramco. Think about the size of the companies that you've said compared to them, or even Microsoft, which is quite small. Quality, they say they have sound balance sheet. Stocks is what they're saying, and we'll look at the depth a little bit more. It says cash flow paying stocks. Obviously, they pay income and lower volatility, and I think that's what people are drawn to first of all with consumer staples. One, they know the brands, and two, they are always classed as lower volatility. So when you have a recession, they're classed as safer. So a lot of people prefer to invest in these because they can sleep well at night. And I think that's one of the big reasons why you invest in this sector.
Yeah, exactly. And I think we all have them in our portfolio. And what I've noticed that when there is a shock to the market or something like that, usually those stocks do really well in my portfolio. They really create this damping effect on my portfolio. So if you see the average market going down by 20%, if you have a dozen of these in your portfolio, it might only go down 10 or 12% or something like that. So that's also something really nice about this if you're sensitive to effectively to capital appreciation, right?
Yeah.
So if you think about them, what is the first consumer staple that comes to your mind and that you want to talk about?
But the first one's going to be no surprise to anyone who listens to this podcast. We speak about them quite a bit, I would say, which is Ahold Delhaize. They're one of my favorite consumer staples, I have to say. It's a Dutch-Belgian multinational retail and wholesale company, formed, obviously, there was a merger in 2016, I believe, and it includes supermarkets, convenience stores, hypermarkets, and they're pushing it now a lot more online. I even have some drugstores and liquor stores if you go over to the US. So I think in Europe, it's probably in terms of dividend growth, dividend yield. I'm going to look at some of the yields and some of the dividend growth rates and some of the other companies we've picked, but let's give an example here. Dividend yield is nearly 4%, 3.93%, and the 5-year CAGR is 7.68%. They are big numbers when you talk about consumer staples. You don't typically see the 7-8% CAGRs lately. So in terms of yield and growth, for me, they top the pile.
And then they have like a 2.5 to 3% annual buyback yield of 1 billion, right? So that's on top of that.
Yeah.
The only annoying thing for me is still that they don't pay a quarterly dividend like Unilever or something like that, right? They pay this interim dividend and final dividend. So, sometimes the interim or the final dividend then is a little bit underwhelming. So I wish they would just start paying quarterly. And I don't know why they don't. Maybe we should ask investor relations one time.
Especially with their presence in the United States, you would think that they would try and appeal to that investor more. We spoke about CRH. Remember, we spoke about them a couple of weeks ago.
Yeah,
in and around. They've moved exchanges from the London Stock Exchange to the US Stock Exchange, and the share price have doubled in a matter of weeks.
I wanted to tell you that I checked it. Indeed, it went from $50 to $85 or something like that by just switching exchange. Just crazy.
Just switching exchange because more people are aware of it. It's on the US. It's available easier to US investors. When it's on the London Stock Exchange, it's harder for them to invest in Europe than it is for us to invest in the US. Could you imagine if Ahold, which is I think the 7th largest chain in the world, moved from Europe to America?
Yeah, exactly. Probably something similar.
I would expect to see something similar.
Yeah, but the CRH story that you told me about is crazy. I
Yeah.
mean, it must have been just a matter of valuation that they saw like, why is this
Oh,
company trading at this multiple? Let's buy it. Yeah, and really easy money for that.
so if we go back way back, maybe this time last year, I think I mentioned it first. We're going a little bit off topic,
Yeah,
but I did mention that was one of the reasons why I bought them so much. Is in that their valuation compared to their peers, it was so cheap that the only way it had to go was up based on its
yeah,
valuation moving to that. And there was a lot of talk around that being the real main investment thesis. It's now trading at levels that's comparative to its peers.
yeah,
But you think of the values Ahold is trading at compared to Walmart.
yeah. Exactly, yeah,
So
exactly.
the same opportunity would be there. I'm not saying that it would happen, but imagine if
Yeah,
it did happen, it would be a
yeah,
good opportunity. But look, the growth from these guys over the last 5 years, since 2016, greater than 5 years, is quite astounding. The problem I have with all these is where does the future growth come from? I know Ahold are deep in acquisitions. I think the last one was a Romanian grocery retailer that they were
yeah.
buying, valued at over 1 billion. So they have to keep acquiring. Then you have this on your online to compete with
Mm-hmm.
Amazon and all these. So they really have to,
Ball.com. Yeah.
yeah, they have to really drive that. So that's my main concern with consumer staples is growth. What are the catalysts for these types of companies?
Yeah, and what you see nowadays, and maybe not particular to Albert Heijn, but just in general, consumer staples in the since the 2000s, the early 2000s, the main tailwind for them was like international expansion. Yeah, because of globalization. But
Yes.
most of the companies have done that, and this is maybe still where the opportunity for Ahold is to gobble up some more large retailers in other countries, as long as the opportunity is decent, right? And embed them into the holding structure.
Yeah.
But I think with their United States and Dutch and Belgium assets, they have some really strong assets. So, but indeed, we shouldn't expect more than slightly above inflation rate improvement when it comes to sales, and then it comes to operational excellence with these kinds of companies. I think they have one of the best supply chains as a retailer. Also, a lot of digital initiatives there, so they are top notch from my point of view. But it's definitely a company where we shouldn't expect a multi-bagger in the next few years from that point of view.
No, no. Hey, if you can pick a 10 bagger from a consumer staple, you're doing well.
Yeah, true, true. But look, the company has also relatively a lot of debt. It's around 15, 16 billion. And it's important for people to realize that if you go to the balance sheet of Ahold, you will see that maybe 4.1 billion exists there in long-term debt. But, you know, you have also like 11, 12 billion in capital leases. Yeah, so it's effectively another way of accounting for your assets, but it's also in the liability section, the non-current liability section, and we just counted as debt. So if you look at it, then this kind of 100% equity to debt ratio for this company. But for me, this one is really cannibalizing its own shares. I believe they had like 1.3 billion of shares outstanding at just after the merger with Delhaize, and they are now at around 900 million or something like that.
Yeah, yeah.
Yeah.
I
So
mean,
6-7 years they reduced so much.
it's a phenomenal rate that they're reducing that, and you can see that in their buybacks. They are just really, and look, we spoke about valuation, how cheap they are compared to their peers.
Yeah.
So I like to see this. I like to see when they're trading this cheap that they do that, but it's consistent. You can see that since 2017, they're buying a
Mhm.
consistent amount back every single year, and all it does is adds value to our shareholders.
Nice, nice. Yeah, I'm very happy with this stock. Of course, because of I mean, there's a strong commitment to the dividend, right? But because it's being European and it pays an interim dividend, there's still this little thing like, I hope this company doesn't screw us over one day, right? I mean, business-wise, it's doing all the right things, but that's the thing with investing in Europe, effectively. Yeah.
Okay, so we have four more to do. Do you want to take the second one?
Yeah, let's take Pepsi. For me, PepsiCo is also one of those companies many beginning investors look at. If you don't know, PepsiCo, maybe some fun facts. Did you know that more than 1 billion times a day consumers drink or consume a Pepsi product, and that they are in more than 200 countries and territories, so effectively every country in the world there. They make around 91 billion in revenue in the last year, which is less than the single dividend of Aramco in a year.
Yep.
But the company was founded in 1898, started really off with the Pepsi beverages, Pepsi Cola. But then also in 1932, Mr. Lay, Herman Lay, began a potato chip business in Nashville, Tennessee. And those companies merged in 1965. So Frito-Lay merged with Pepsi Cola, and that's why we know the name PepsiCo now. So what's interesting about this stock? A 3.12% dividend yield. They pay a $5.08 forward dividend. This has been growing about 6% on average over the last 5 years, and they have 51 years of growth. So they have been paying a quarterly dividend since 1965, and they intend to increase the dividend each year going forward. So if you look at their dividend chart, it's really a nice staircase, a really nice one. Yeah.
Yeah.
But PepsiCo itself, people often think about the drink and the Lay's chips. But for instance, they also own Cheetos that you see in the shops. They own Doritos, Gatorade, the energy drink, Lipton iced tea, Mirinda, which is kind of the equivalent of Fanta. I believe it's Quaker's, I believe the cereals. 7-Up. It's for our American listeners. It's something like Sprite here.
Yep.
And also something like Tropicana. So they have quite some billion-dollar brands. It's really amazing. And if you just look at the list, I know almost all of them. So if we then look at how the company has been performing lately, it's so-so. Not a lot of fireworks. They did make 6-7% more in revenue, but it all gets eaten up by cost of sales, admin expenses, SDNA expenses, and such. So not a lot is left then again, and they have around 10% net income yield if compared to the revenue, which I believe is a much lower margin than, for instance, Coca-Cola.
Yeah.
But if you then look at the net income, it has hardly been growing, right? So even though the sales is growing, they're not able to turn this into significant bottom line results, which is a little bit concerning, I must say, because usually you want a company to grow like this 2-3% in revenue and then 6-7% in net income. If you look at the historical averages of the company, and you look at just for instance, the free cash flow or the earnings per share, it's been pretty much flat since 2015, a 20%, 15% growth, which is really, really not a lot. But the payout ratio has been heavily increasing. And what's even generally more concerning for me is that the free cash flow is not following net income, which I usually like to see a little bit around, which has resulted in a lot of debt. They have around 37.5 billion debt, according to the last statement, but only around, let's say, 18 billion of equity to shareholders. So they have a 200% leverage ratio here, I would say. And the dividends are also hardly covered because the dividends are around 6.7 billion. And then if you look at the free cash flow, it's been around 8 billion. And they're also doing some share buybacks. So there's really not a lot of wiggle room for this company. And that concerns me a little bit, honestly. Yeah. So PepsiCo, good story, great history. But this is one of those companies where I feel like, where does the growth come from? I don't know. They're hardly buying back shares. The shares that they have been buying back have been mainly effective in like fighting dilution.
Yeah.
So not really reducing the share count with any significance. And yeah, earnings growth is not really there. So how long can they continue hiking the dividend? That's really the big question mark that I have with PepsiCo. So I've got quite some concern there in the dividend safety, if we think about it over the next 5 to 10 years from now.
Yeah, I mean, full disclosure, they are marked as questionable in our own dashboard, which I'm learning over time not to disagree with, but it's purely because of the amount of debt on their balance sheet. I mean, for me, it's too much.
Yeah, and the payout ratios.
Hey,
That
just
they have payout ratios like a real estate investment trust.
even more, it's close to
Yeah.
100% nearly at some point. So, look, I know a lot of people are very happy with Pepsi, but for me, I would be concerned if I owe them. They have some really strong brands, like you said, but it's hard. Like how you can't continue to grow them into perpetuity. I mean, at some point, you need other brands, you need something else.
Yeah.
I don't know. It's tough. I struggle. I do struggle with Pepsi. I have to say, I know all their brands. I don't particularly like many of their brands. I have to say, I prefer other brands. So I struggle with that, and the depth on the balance sheet just concerns me too much. That's why I couldn't invest.
Yeah.
But how about their competitor,
Coca-Cola? Well, you tell me.
Coca-Cola? So I mean, I think a lot of people that get into dividend investing will hear of Warren Buffett, and that's probably one of their first pathways into dividend investing. And what is he famous for? Investing in Coca-Cola. For me, it is one of the world's most iconic brands. I don't know anybody that doesn't know who Coca-Cola is, even more so than PepsiCo. I'd say the brand of Coca-Cola is far, far stronger in my opinion. Look at dividend yield, we're looking at 3%, but the dividend growth has been quite lackluster over the last 5 years at only 2.83%. And actually, if you're to look at their growth between 2012 in terms of revenue, top line and bottom line, it didn't make for good reading prior to 2020. And we know this because they're going through a restructuring. They are getting rid of all their bottling franchises, and they were doing a complete restructuring of that. They were targeting 2020 as the year that we're going to start to see growth, and then bang, we hit with COVID. That kind of hit them a little bit, and then bam, we were hit with high inflation, and that hit them a little bit. So growth in terms of revenue, top line and bottom line, has been quite slow, I would say. But the only difference I see here between them and PepsiCo is that they are actually paying down their debt. Back in 2020, it was up around 40 billion. It's now down at 35 billion. So they're paying that down quite well, I would have to say, over that same period. What did actually surprise me is you mentioned PepsiCo has a 92 billion annual revenue, and Coca-Cola only has 46. That surprised me. I actually thought they would be similar, but I know PepsiCo obviously have a more diverse product range in terms of food and snacks, even though Coca-Cola has over 500 unique brands worldwide, which is phenomenal when you think 500. But the question for me is always, where does the growth come from in the future? So 61 years of paying a dividend, there's no question that they are committed to it. They can still afford it, even more so than PepsiCo, albeit they pay at a slower rate. I think PepsiCo is 7% CAGR over 5 years, and we're talking about 3. So it's much more slower. It's much more sustainable, I would say. And you read through their latest annual report or their quarterly earnings, they're trying to make a push with this digitalization, which all companies are trying to do. But I think to myself, a company like Coca-Cola, you sell soft
I don't
drinks.
like digital Coca-Cola.
I mean,
I need to have the real liquid.
How does this make sense? How can you make money from that?
Yeah.
For me, I struggle with that, but you can see that they're using like a lot of marketing. So they're using this AI marketing initiatives to try and draw people in, that they can design their own flavors. They give them a mix of 200 or 300 flavors, and it gives them an online experience into making it. So you almost feel like they're trying to give you an experience online rather than selling their product, and then by that you're into their ecosystem, and then they're buying their products, which I find is a interesting way of doing it. But what do they have to rely on heavily here is their marketing. That's the biggest driver. And to be fair, they call that out. They say marketing is the critical driver in their growth algorithm. And they're also going to reduce their portfolio by about 50%. So they're going to take that 500 brands and try and reduce that and focus on only 250 of the other brands, which is phenomenal. But again, I struggle. On paper, the idea sounds nice, sounds good. I mean, you give an online experience, but I just think when I hear digitalization from companies like Coca-Cola, I struggle with it because, as you said, you can't drink digital Coke. But in terms of dividend safety, in terms of commitment to the dividend, I think they're in a far better position than PepsiCo.
Yeah, they have been also just more conservative with hiking the dividend, right? They clearly stick to their own, let's say, guardrails when it comes to dividend yield, not yield, but dividend payout ratio and such, and they've been doing that well. Yeah, I just don't see a tailwind for this. I don't believe that digital is going to really bring them anything new. I think it is something like they just have to do to not to avoid losing customers. Yeah,
Yes.
but like, okay, at every corner in the world, you can buy somewhere Coca-Cola. Yeah, it's as simple as that. So I think they need to really continue working on portfolio extension. They have also the Costa Coffee brand. It starts to contribute now a little bit to the bottom line numbers. But this is a big whale. So if they want to buy something, that they really need to open up the wallet, and stocks are not cheap. Yes, so they can't buy themselves also into growth, which makes this very interesting as a case study, I guess, for the Harvard Business School. But for me, I think, look, these are good companies to have in your portfolio in general when you think about it. Yeah, but then I believe if you take something like Coca-Cola, Pepsi, you don't want it at a 3% yield. You want it at a 4.5% or 5% yield. That's where you want this, because it's very slow growing. You will never meet the Chowder rule of 12 with this. There's risk here in the balance sheet. Although, as I mentioned before, these companies can have more debt because of the slow growth that goes also in the other direction, the opposite. It's not like suddenly their sales can fall off of a cliff, also not. But you just want more yield for this in return, because you can't get it from the capital appreciation either. You don't get it from the dividend growth. So then it should just, in my opinion, deserve a lower multiple.
Yeah, I completely agree with you. These types of companies are in your portfolio for stability. You can count on this,
like a bond.
Yeah,
like a bond.
Exactly. You can count on this 3%, and that's it. I wouldn't expect much more growth after that in terms of total return, capital appreciation, or even dividend growth. And you can see why sometimes dividend growth investors get some heat on Facebook from other types of investors, because they look at companies like Coca-Cola and say, why bother? You might get the same in a bank or a treasury if you want.
And at this moment in time, that's definitely true if you live in Poland. Yeah.
So you can understand it, but in terms of brand power, and as you said, just that safe foundational stock in a portfolio, I think Coca-Cola is still up there.
Yeah. Good. So then a company that I want to talk about is another retailer. It's Target Corporation. Yeah, you spoke about Ahold Delhaize. For me, Target Corporation is also a nice one. Why Target and I said and why not Walmart? I think Target still offers a little bit of a better entry yield. It's only 2.6% now. I believe the share price is trading now around 160, 165, and just a few months ago it was trading at around 110. So I hope enough people bought at the time. But for people that are not familiar with Target Corporation, it's really one of the bigger companies in America providing these hypermarkets, discount department stores and grocery stores. So I call this kind of the everything store. I know this is what the book of Amazon was titled at here, but if you think about it, it's one of the largest retailers in the US, and it really offers a lot of products like clothing, electronics, home goods, furniture, and groceries. And this is very important to mention, the end groceries, because this company is a little bit more sensitive to the cycle. If we would see a downturn or something like that in the market, I don't think many people will continue buying electronics as their first need. It will be food. Yeah. So I have seen over time that this company is a little bit more sensitive to that. But they have also Target stores, super Target stores, but at the same time also the small format stores. So it really offers a wide range here. But what I like the most about it is their customer loyalty program, because if you follow Ian Lophook, Three, 4 years ago, he did a video with his wife, and the wife was introducing Target to us and really talking about how the loyalty program has really been great for her as a consumer. And that was quite eye-opening because Ahold has also some loyalty programs. So it really resonated me a lot with me when she mentioned that. So if you think about it, this company spots 56 years consecutive dividend growth, a 5-year dividend CAGR of around 11.1%. And this is specifically because between 2021 and 2022, they hiked the dividend from $3.20 to about $4. Yeah, so that was a major hike at the time.
Yeah.
They pay $4.40 in a forward dividend. So yeah, that's why 2.6%. 56 years of growth, guys, really a lot. They make around 108 billion in revenues approximately. The dividend is relatively well covered. They have like an earnings per share of $6, 4.4 goes to the dividend. So from that point of view, I believe we're in a quite good situation here. They did have a tough fourth quarter. They had 4.4 reduction in comparable sales, and a GAAP EPS of $3. So it's actually probably their normal EPS is probably more like around $8 to $10. Yeah. So and that was what it was, right? $8.94 was the GAAP EPS over the entire year. So I was more talking about the forward one. So yeah, generally speaking, for me, this is a very interesting retail chain. I prefer this one over Walmart. Walmart for me is always too expensive. Of course, if Walmart would be at attractive prices, as it was trading one time when Amazon was going to kill all the retailers, yeah, that was my opportunity to buy, but I didn't do it at the time in 2016 or 17. So, but since then, I've been just waiting for Walmart to come down, and yeah, then I prefer Target, and we had an opportunity not too long ago in this one.
Yeah, Target. I mean, I've been to America a couple of times over the last 2 years, and Target seems to be the shop everybody wants to go to. My sister lives over there. When I was going, it's always, let's go to Target. Nobody ever said to me when I was over there once, let's go to Walmart, which is always quite interesting. And when you follow social media, I see sometimes these funny little memes where the husband is forced to go out to shop, but it's always Target. It's never Walmart. So to me, that just shows the branding that they have, and actually they're quite popular over in the US. Sometimes it's hard as a European to get a sense of what these companies are like. Obviously, Walmart is one of the largest companies in the world. It is quite popular, but I always get a sense that Target is just more consumer friendly and maybe cheaper. I don't know, but it's yeah, so it's always appealed to me more. My goddaughter living in Ireland, but because she watched so much YouTube, when I went over to America last year, all she wanted, and Zoe, if you listen, hello, all she wanted was a Target bag. I'm not joking. You know that, like, you go and get a plastic bag? She wanted a bag from Target. So I took a picture and I was there. I video called her going around the shop, showed her the bags, brought her back a bag and some gifts. And
nice.
But all from YouTube. You get me? Like, it blew me away. But to me, that just showed how popular and how much brand power Target had.
Yeah. Wow. Nice. Yeah. So yeah, Target is my choice. But this was just only number 4. So what's number 5 then?
Yeah, let's bring it back to Europe. One more, maybe more UK based. I don't know if you can class them Europe anymore. They left this, but Reckitt Benckiser, ticker symbol RKT.L on the London Stock Exchange. Again, it's a slow grower in terms of dividend growth. It's only 1.37 and a 3.7% yield, right? But they've changed their dividend policy recently to a more progressive dividend policy, is what they're saying, where they target more European style dividend policy, where they're going to pay out 50 to 60% of their earnings. So again, that dividend growth will only hold true for as much as they grow their earnings and their net income. Those that don't know the brand, and honestly, I didn't know the brand before that, even though I know a lot of their products, but they are a British consumer goods company, and they own lots and lots of brands. Actually, 70% of their revenue comes from brands that are number 1 or number 2 in their markets, right? And just to give you an idea of some of their brands, because I'm sure that you'll hear some of them. So you have Gaviscon, Nurofen, Strepsils, Finish, Dettol, Airwick, Vanish,
I mean, these are some big brands all over the world. And actually, one interesting fact, I don't know if you know this, but one of their brands, Lysol, is present in over half of all US homes.
Wow.
That's incredible.
Yeah,
Yeah,
definitely.
that's one thing that blew my mind away. So look, I think in terms of brand power, this company definitely has it. I didn't even mention, because I'm waiting for you to say something. I didn't even mention their intimate wellness market, which is number one, which is Durex. They also own that company as well. But I think, look, from brand power, I think it's fantastic. They got really really strong brands. Again, the question always comes to me: where does this growth come from? Now, I know that they are driving really, really hard with their online business and selling stuff
Mhm.
online. And actually, e-commerce is growing. It was 12% of the company's revenue when I last looked at these, I think, this time last year. Um, and that's, I think it was 5% the year before. So you can see within a year that it really grew. They did really, really well in COVID. And I was a little bit disappointed that they didn't make use of the cash that they made during that time. Because if you
Mhm.
remember back in COVID, everybody was, I would say, more
Stocking up on Durex.
not, not, not the Durex, but you know, your Lysol and all these other
Yeah,
detergents and making sure everything
yeah.
was clean. They did really well, actually better than average. They were doing
Mhm.
from that time, and I don't think that they capitalized on it. But since then, they've announced a 1 billion buyback program. As I said, they've changed their dividend policy as well, and they're really trying to drive this online business. They're also trying to pivot slightly, and I think this is actually a good idea. So they're trying to focus a little bit more on immunity and senior nutrition. It's the first company that I've seen focusing really pretty much on senior nutrition. We know
Mhm.
we're in an aging population, particularly in the UK as well. So I think that's a strong move. So look, 16 years of dividend growth. They have a good bit of depth on the balance sheet. They are kind of reducing it slowly. In 2020, it was 9.8 billion. They've reduced that to 6.6. So they did use some of that cash that they made. In terms of shares, it stayed flat for the last 10 years, but they've initiated that buyback program now and their new dividend policy. So it's an interesting one. It just comes back to me about valuation in this type of company. I think it's still slightly overvalued, but it's a company long term as a foundational stock. And if I'm from the UK, I kind of like this type of company. I mean, everybody has at least one of their products, I think.
Yeah. Well, it's not too bad, right? It is a forward multiple of 14, let's say here. So it's not too bad when you think about the valuation. But from a UK point of view, as we discussed earlier, it's not so interesting.
Yeah, I think all companies in the UK are cheap or than their peers at the moment. So it might be cheap on a European scale, but maybe in a UK context, is maybe not as cheap. But look, as I said, brand power, change of policy. I think it's an interesting pick.
True, true. Well, hey, guys, these were 5 consumer staples. If you're new to dividend growth investing, I would definitely say like check some of these out. Yeah, just go to internet and Google otherwise for the largest consumer staples companies. There you'll find a list, and I'm sure that some of these that we discussed today are also part of that.
Yeah,
All of these spot great dividend track records. Some of them are actually a dividend king,
yeah,
yeah, which means 50 years of consecutive dividend growth. They really stood the test of time. For many of them, they were there already hiking dividends during the oil crash in the 80s, the housing bubble, the dot-com bubble. They have survived everything from that
yeah,
point of view.
yeah,
Yeah. So yes, there are some risks here when it comes to payout ratios, but still strong iconic companies here.
yeah, yeah. And we deliberately stayed away from, as you mentioned, the tobacco companies, which would be classed as in the same category, and also the alcoholic ones like Pernod Ricard, like
Correct.
Heineken, like the Budweiser one. I can't remember what it's
Yeah.
called, but we stayed, and Diageo. We nearly forgot about Diageo as well. So we deliberately stayed away from them. I think the ones we've mentioned, in my opinion, would be safer stocks that will be around for a long, long time, or companies,
Exactly.
not stocks,
Exactly.
companies that will be around for a long, long time. But with that, let's get into some listeners' questions. And Simon asked us the first one, and the question is: At what age or in how many years do you think you'll both hit your financial independence goals? Do you imagine immediately making a change to your lives, or will it be more gradual once you pass FI?
Yeah. So I think I should be able to do this in 4 years from now. That will be like slim fire without a margin of safety.
Slim Shady
Um,
Fire.
yeah. So I think it will be gradually. I really love the work that I'm doing. Yeah. As such, so I don't see a reason to stop, but I can imagine, taking the pressure off, working a day less or something like that to start off with, and to start slowly going into it. If I studied people that were going into this mode, often they started working even again after some time. Yeah. Um, but I really don't know. My thoughts have been changing over time. Ask me again in 2-3 months.
Yeah.
I could also just, for instance, only do blogging, YouTube, and talk about dividend growth investing. I don't know how that would be if I would do that full time. Yeah, because that would make from your hobby a job.
Yeah.
Yeah, that's something different. It's now a side hustle for me, which is still like very much on the passion end. But if it becomes a job, I don't know if I would like that.
Did you ever hear of Murphy's Law?
Yes. Yeah.
And
If it
anything
can
that
happen, it will happen.
anything that can go wrong will go wrong. Okay. And my mother's maiden name is Murphy, and we've always lived by that when you're making plans. And like you, I've been changing this over time. What I will do, what I won't do, and it keeps changing. But what I've learned is not to make those plans. What I really want is to have the ability to make a decision
Yeah,
comfortably
exactly.
without having to look back. And that's the position I want to put myself in. Whether I stay in work or not stay in work will depend on lots of different factors at that time. But if I'm financially able to make a decision one way or another, that's what I'm hoping to do. I'm not 4 years off it. I'm probably more like 8, I would say. I have a higher yielding portfolio, so maybe it could be 6. I don't know, but
Yeah.
we'll say 8 to be sure. But look, in 8 years' time, if I'm in a position where I can give up work and pursue other opportunities, if I wanted to, I will be more than happy. If it takes me 12 years, I will still be more than happy. I'm quite fulfilled in my job. My whole thing here is just to have that bit of a safety net, and if not me, my kids. That's the main goal.
So maybe we are becoming like the Warren Buffett and Charlie Munger. Let's say they were also having, their businesses. Munger was a lawyer and such. So at a certain moment they reached financial independence, and then they still have 50 years ahead of them. Maybe we will also become like kind of two Muppets later, getting a stadium full and doing an annual conference. That would be so fun.
That would be the best thing ever. That's hey, screw Murphy's Law. That's my new plan. Bass has asked us, how do you look at diversification over time? You seem to follow an approach of buying sector stocks that you think are undervalued. So when do you stop adding, and when do you feel that you're overweight in certain positions?
Yeah. So generally, I've got a tier system which is set up towards my target situation. So let's say for tier 1 stocks, I don't know, 20K, 30K, something like that. So I know how much I can add. I don't want to buy all at once, but I do make use of the opportunity when a sector or an industry is undervalued to buy a little bit more than usual. But I also add still a little bit of others typically in the mix. But lately with insurance stocks and the real estate investment trust, I'm just a bit more overweight there, because I probably in 2-3 years from now, this opportunity will be gone and it will need to just grow on its own. So I do have my target positions for the stocks in my portfolio, depending on how I classified them, where tier 1 is like an anchor stock in my portfolio, towards tier 4, which is like, I don't know this stock too well yet, like I did with Yatris at the time. Let's buy some and let's see how it goes, but it needs to really convince me before I upgrade it.
Yeah, I feel like it's a lesson I'm still learning in terms of that. If I go back to Shell, I remember not buying a lot more of them at the time because it was going to be too overweight in my portfolio, even though it was screaming at me that it was relatively cheap, that everything was going right for it. Oil was apparently dead, even though we knew the planes were still in the sky, the cars were still on the road, there was oil still being used. So at the time, it prevented me from buying more. And we mentioned this last week, if you remember, buying insurance and real estate. Sometimes it's hard because I feel like I'm buying so much, but that's where the opportunity is. And I think sometimes I have to learn to follow that opportunity a little bit more and not hold myself back. But then on the flip side, you have that risk of going too hard and being wrong and losing a lot of money.
Yeah.
So it's look, it's
Sure.
still something I'm trying to learn. Tim Ainley has asked, which dividend growth companies do you consider to have a true long-term mindset?
Which dividend growth companies? Oh, that's an hard one. I do think like Texas Instruments, and he mentioned it as well. I really feel like how they're doing with the cash flow at the right time. You know what? Typically, these are family-owned or founder-led businesses where I see this. For instance, take Starbucks with Howard Schultz. Is it Howard Schultz, the CEO? He stepped out, came back, and he's really running Starbucks for like the decade to come, let's say. I also see this in Microsoft, actually, Satya Nadella. So for me, those CEOs that really have a long-term vision, yeah, that's those are some of those that I think of. I think most of the others, like even Unilever, I feel like the CEO is focused on the short term repairing the business, of course, with a long-term impact. But every CEO will say that. But typically, you see this with family businesses a lot.
Yeah, and I think the short-term mindset is a consequence of the world that we live in. Everything is accessible on your fingertips, and you want everything now. Everybody, and that's not just investors; it's in all walks of life. But it's obviously going to translate over to investors, and I think the art of patience is slowly dying out. And I, I agree with you. It's hard. It's easy looking back, and we can look at the companies that had giving us that long-term view. And I would argue Coca-Cola still have that long-term view. But as you said, shareholders want results now, and that forces management and board's hands and so on. So yeah, I think that's a very, very hard question to answer. Texas Instruments, as Tim has said, is a good example. But it's hard to pick so many more of these. It's quite a difficult question. Leoc Van Kostem has asked us, did you sell your Enegas position?
Yes, I did. I sold them all, and I will be reinvesting it somewhere. Yeah, definitely. I felt like if the only thesis of the high yield is gone, then I'm gone. As simple as that.
Yeah, I have a sell order in. I don't know if they sold or if it hit that position, but I'm 100% getting rid of them as well. So they will be gone, as you said. It was high yield. 2026 is what the management promised me. They lied to me. They are gone. Alexander, what do you think of Bristol Myers Squibb?
That's a really tricky one. I think it screams value as such. Very strong cash flow, good payout ratio. So it's swimming in cash. But the issue with this one is like, where is the pipeline? It's as simple as that. And that's why they are struggling. And you see that with a few pharma companies, and Bristol Myers is a classic example of this. I think once they get some successful pipeline readouts, this company can really quickly almost double, I would say. Yeah, but until then, the biggest risk is actually patent expiration, and that makes it so hard. They should really massively buy back shares now, in my opinion.
It's one of the reasons they're trading so cheap is that pipeline and this patent expiration. So it's a risk. It's probably similar, maybe some similarities to AbbVie back in the time.
Yeah. But we also got a question actually about Novo Nessis the other day, right?
Yeah.
And Patrick is keeping us accountable. Like you must have looked into this over the weekend. So generally, Novo Nessis is a merger between Novozymes, which is again a spin-off from Novo Nordisk. If you're unfamiliar with Novozymes, it's effectively focused on the production of industrial enzymes, microorganisms, and such. And they merged with another Danish company, CHR Hansen, a Danish bioscience company. So they are really, again, into creating bacteria, probiotics, enzymes, And that's where I think you see the connection. So it seems to be a good fit on the surface. I don't know the product portfolio well enough of the two of them. I also don't know yet what the dividend will do. They will trade further under Novozymes. It will continue there. They will announce the dividend anytime in the upcoming, let's say, 6-7 weeks, and then we know more whether they will continue the dividend streak. So it's a bit too early for me to have any judgment on that. But of course, if it results in a dividend cut, then we'll have to kick it out of the Noble 30 index.
That'd be a shame. And then maybe the last question from Jean Christophe. In the last episode, we talked about insurance companies, which we did, but we have not mentioned a company like AXA. It's one of the biggest in Europe, in the UK. Have you ever looked at it?
Yes, I've ever looked at it because I remember AXA as a brand, AXA, because every Dutch bike almost in the 90s had an AXA sticker on it for the lock that was on the bike. That's where I know it from. I believe it's the insurance company. Here, I've looked into it, but I remember there was something with the dividend track record which made me look the other way. So that's really the only reason. And then you know when I see this, I often don't come back anymore looking at that.
Yeah, AXA was quite a big brand over in Ireland as well. If I remember, they sponsored the FA Cup, and Liverpool won it, and Liverpool brought the FA Cup over, and there was an AXA insurance company quite near where I live, and you could queue up and pay there. But actually, as a business, I've never actually looked into them. Something similar to Aviva, which is big over here as well. I just never quite got into them. I think NN Group and ASR kind of popped up in Legal in general, and they looked massively undervalued. And honestly, I don't think I need too many more companies in insurance in my company. I just buy an ETF if I keep going.
And I'm just looking at it, and they seem to have cut the dividend in 2008, and they cut the dividend also in 2019, I guess around COVID times. So, that they are back on track. So you could, hold one hand in front of your one eye with the COVID situation. But for me, I prefer the other ones.
Okay, so that's the last question of the day. Again, thanks to all our listeners for tuning in, for asking us questions. We do really appreciate them. European DJI, thank you for doing this on a Monday, straight after work. I know I put you under a little bit of pressure here, but thanks so much for getting this together. And
yes, definitely.
We hope everyone enjoys it, and we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.